What are hedge funds doing right now, and why should we be paying attention? In today's video, we take a look at the effects of the options market on what the S&P 500 is doing, even in the wake of potential reinflation. With yields still not breaking below key levels, everyone seems to be moving for safe havens, and one of those is silver and gold. Can they go higher, and where do we think they could be in next 3 to 6 months? In today's video, we'll discuss that along with some of the biggest wins over the last couple of sessions. This all ahead of big earnings from Nvidia coming up next week. Guys, today we talk about stocks, commodities, and cryptos right now. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we need to look at cash levels and what hedge funds traders are, of course, doing. We'll also be breaking down the latest macro data and the hottest charts for you, and we'll look at it all together right now. But let's start with the biggest story, which is probably what are the hedge funds doing right now? And it looks like they're doing rotation. As we've mentioned over the last 3 to 6 months, we believe that Wall Street is in a place where we're going from a mid kind of cycle to a later cycle in the stock market. And that means that what was hot, such as financials, may suddenly become a little bit less. And we're already seeing this move through consumer discretionary and consumer staples, which is now not the favored market area of the hedge fund, and instead they're going into materials. You may say, why? Well, it could be concerns about inflation. Regardless of any of this, though, we did see hedge funds continue to purchase in last week, and generally be bullish. And as of course we already reported, they had some exceptionally large, big entries the week before that. But what is the concern right now? Well, the concern is simply that we are at 15-year lows. Yes, cash levels are really low right now, and it looks like managed funds and everybody else is basically still stacking into the market. Now, we do know that some smart money, and we'll share this in our next video, so make sure to subscribe, is currently reducing their positions. Most notably, one of the smartest monies is, of course, Buffett. What exactly is going on there? And most of you are probably aware of this by now. But I think the key is that when you have cash levels this low, traditionally that's meant that margin is starting to play into the markets. So people are starting to take leverage, and we've already shown several times that 3 times levered funds are now being used more by retail than ever before, and it is exponentially growing on the month-by-month basis. And this is a cause for massive concern this year, and obviously something that we all need to be paying a lot of attention to, which we'll update you guys on incrementally as we see them. Now, one of the biggest things is flows. Of course, most people are probably aware during first presidential years and just generally February, you tend to see a bit of weakness into the end of February. And while this is not a statistical 100% fact, generally that is coupled by hedge funds starting to lower or even going negative on their flows. We have not seen that, though, in 2025. So just remember, we could completely buck this trend, but generally first half is good, second half is bad. Ultimately follow price action. And why will that be key? Because price action is not expected to be as easy this year as it has been during 2023 and 2024. Where we're in a recovery, we were climbing the wall of worry, and obviously markets were absolutely ripping for some exceptional gains. In year 3 markets, we tend to see up, down, and all around. And while we can drive higher throughout this year, do remember price, options, volume, dark pools, all these things will matter. So the question then becomes, do we think we've topped yet? Well, margins typically peak more than 1 year ahead of equities themselves. And for now, we're still seeing equities going up, and we're still seeing margins overall increase. Now, this is a very important factor. Only one time in history has this not worked out. And you can see here, that was in the 80s. So 1980 to 81, generally speaking, if we were going into a recession, it was well after we actually saw these levels mark out. So of course, that's something we'll be tracking throughout this year. Another one is that we actually ended up having a very negative type of number there in December, which is, of course, we undercut that. But by Valentine's Day, we actually managed to get some gains back in the market. Now, usually when you're looking at a market that actually goes to the downside and downcuts that December low, which we did so in the Q1, we don't see such strong regains back in the markets. And of course, previously, when we've had similar periods to this, you can see the returns were still quite good. And that's an encouraging figure for a lot of people that are still feeling the bullishness. Another encouraging figure is, of course, just the net negative sentiment, it seems, from retail traders. We noticed last week that, of course, the spread between the bears and the bulls was getting incredibly bearish. And I would say this is due to people paying too much attention to the news and the narratives rather than actually looking at the price action itself. If you've been watching the channel, you'll notice that we've been quite bullish throughout all of this. And the main reason is because if it's in the press, it's probably in the price. And ultimately, we need to be watching the flows and the momentum. So still for now, it does look like the bulls are in control. So what do we need to be looking out for? Well, with sentiment reads like this, you can see here, FundStrat's latest data basically shows that usually the targets over the next 6 months are still pretty good. But I think it's all coming back down to rotation. We've talked a lot about how China is probably one of the undersold, or most oversold and most underpriced kind of markets. And so far, that's been one of the best returners of the year. But the other one people have been looking at recently has been Europe. If you actually look here, according to the latest Wisdom Tree data, Europe is up 10.28%, probably a little bit more now. And the 1 month is just crazy when you look at it on paper. I would say, though, that, of course, while emerging markets, Europe and everything else is doing better, and of course, China's doing well as well on the stock market anyway, remember, it will be about rotation. And what you'll be looking for is different sectors this year to possibly the ones you've always been looking at. If you take a look at the last kind of 1 month, financials have done well. But one of those other sectors we've discussed quite a lot recently, which is healthcare, is actually up there at the best year-to-date return. And of course, starting to creep up a little bit, even when you're looking at a 12-month rotation, 16.48%. Still behind the S&P, and not as good as the financials, but you know what, it works. Basically, we eventually go from underperformers to overperformers. So could this year be the year of healthcare? And if it is, what does it mean for us as investors and traders? Well, it could mean the kind of beginning of the end, really, especially with margin. If the market starts turning defensive, we need to be paying attention. Where are the best valuations right now? You can see here on the chart, S&P 600 value technically has the best valuations on paper. Does that mean you go and buy that one? Well, historically, no. The gainers have always been in kind of the more growth stocks, but something to keep in mind when you're taking a look at valuations on the markets right now. And then, of course, comes the question of, will we actually get a significant pullback this year? While things still remain bullish, although there are so many weird warning signs starting to prop up, we still need to be thinking about a couple of things. One, will we come back to the 200-day moving average? Since 1990s, as we've already said, this has happened every time we haven't touched in the previous calendar year. And 3 of 5 of those times, it's happened in the first half of the calendar year. So it's something to keep in the back of your mind. The 200-day moving average needs to be put on, but we still think that generally sentiment is pretty good. Here are the earnings for this week. Ultimately, it's going to come down to NVIDIA next week, so stay tuned for that. We've got a great weekend special for that video. And these are the semiconductors right now when you're looking at PEG ratios, PEG ratios. And you'll notice that NVIDIA and AMD actually look okay when just looking at this stat. Be careful, though, when you're looking at any one stat. One other thing that I thought was really interesting was this chart here, which is China stocks, PE versus revenue 3-year growth. And you'll notice that people are super bullish on Xiaomi, and basically that stock is literally vertical in China. There are, of course, some laggards that are starting to come back. And the big story here over the last couple of sessions was, of course, anyone in the Z meeting in terms of the CEOs, that was looking pretty good. If you weren't in that meeting, which I think Baidu wasn't, I'm not sure why, maybe someone can let us know in the comments down below, that's not so good. So these are the big names. Obviously, these expected forecast growths are starting to creep up there again, and that will allow expanding price to earnings ratios and, of course, potential further bullishness in those markets. When it comes to the crypto market, there's no doubt this thing's tanked at this stage, and of course, we are still holding within the same range. Few too many days sitting here, ultimately, but still holding barely bullish structure. And we'll talk about that soon. And of course, the latest flows, as of the 14th of February, we managed to see a slight uptick in both Bitcoin and Ethereum flows. Now let's jump into the charts and have a look at the positive gamma from the options side. First up, of course, we want to be taking a look here at the S&P. The S&P closed at an all-time high, which is a pretty exceptional thing to do, of course. We are in what we would call positive gamma at this stage, as long as we stay above 6,100, which we know is a super level for this market. and it seems to be pushing towards that magical 6,200 level. So all green, all good, strong close. Obviously, it's holding up. You've got to kind of go with that flow. Could it be a trap? It's possible, but you don't want to predict those. As we often say, patience, react, don't predict is the key thing here. And so far, all the reactions we've seen of the market have been in the bullish location. They've all been bullish. They've all had bullish wicks. They've all been generally very, very much towards the buy side. And of course, we saw retail go against that because of the news and because of the narratives played out there. So we managed to get here to the options high and low levels. You can see we're slowly kind of creeping up there. And even if the market comes down, 60.50 in particular could now be a major support. And you'll see why, because if you look at the next couple of days of options, take a look at this. The put walls are sitting straight on those levels. And of course, 61.50 is now the breaking point to get us back to that, or get us to that next level, which is going to be 6,200. And 6,200 is now showing up in the March and, of course, also in the February kind of expectation. So generally speaking, we are in pretty strong positive gamma at this stage. When you go over to other markets, are they starting to improve? Well, of course, 140 is a very strong level for NVIDIA. I wouldn't be surprised at all if NVIDIA sat around this level until earnings, up, down a few bucks. If it gets through 150 in the future, NVIDIA could absolutely fly towards those 170 targets that a lot of the big banks have on it, of course, and this will be a huge market earnings result. We also know with Tesla, it's kind of pushing towards that 360, 370 when you're taking a look here at the options level. So certainly one to be on the lookout for and one to be watching. So certainly something we will be watching over the next couple of sessions. So let's take a look at whether the market is actually freaking out at this stage. And of course, by most metrics, it doesn't seem to be doing so. One of our favorite reads has always been to look at the options market, and then of course for bonds, and then look at whether there's a freak out there. Often it is a precursor of something going on. As you guys can see, all good at this stage. So we're not really seeing any problems there, although we have seen, of course, a little bit of an uptick on the US 30, 20 and 10 year as the expectation of more rate cuts seems to be kind of dwindling by the day. If this does break to the downside, obviously that could also be a little bit of an inkling that some markets may do better, and particularly some of the ones that are really heavily leveraged and need to resurface and regain their debts over the next year. Let's now have a look at treasuries. They drop because, of course, of the market actually going up on yield. So treasuries obviously starting to consolidate around here. No huge dark pools in terms of large transactions coming through just yet, but we will be watching. And when we take a look here at home builders, you'll notice this is continuing to be relatively weak, still holding the structure, but starting to look weak. If home builders starts to give up the ghost, that could also be another sign for us as traders and investors that things are starting to get bad. But we just haven't seen it yet. So, of course, we still remain positive at this stage. The US dollar starting to weaken. Of course, going through 106 will be the key down here. And if that does happen, it's really going to fit into our narrative that we think we're going to get a weaker dollar over the next 12 months. And for now, that seems to be what's happening on the charts. What about gold and silver? Well, I still think gold may be in consolidation. Everyone's bullish on gold. Of course, talks of gold being backed against the US dollar and all sorts of things going on. And while I am very bullish, as you guys know, we've been incredibly bullish since the 1700 prices, then not 1700s, by the way. So that about like 2 years ago, months, in terms of when we started to buy it heavily, we still think that this can go to $3,600. However, 3,000 has obviously always been our target, but it could even go further, considering the great backdrop for the metal. I wouldn't be surprised if it does do some sideways action for now, something similar to this, and then we start to bounce back up. But of course, the all-important one actually is going to be silver, because silver had some shocking candles on it last week. Take a look at this huge rejection, and you'll notice that that was after breaking above the very important first resistance of 32.60.70. Now, this is kind of an important position because, as you can see here, if we fib from the high to the low, we're starting to get into that golden pocket, that 61.8. If a bear is going to sit there, this is exactly where they'll sit. So for shorters pretty much want to be coming in right now, stops above the high and going for it. I have an inkling that maybe, just maybe, silver can actually hold up here and bust to a new high. But this is a very important zone. You can see some strong reactions off it initially, straight away when it got hit. So it'll be interesting to see who wins this one in the bulls and the bears. Probably going to know in the next couple of days based on the closes. But now I'm still bullish on silver overall on the higher timeframes. When we take a look at oil, it is slightly bullish on the small timeframes here towards buyers again. Although this is the toughest trade probably of 2025 with the geopolitical tensions. And if we get through 73.4.5, that's going to be a very bullish sign in the future, of course, for what we're looking at. Now, when we take a look at Tesla, this is an interesting one. We've got a great level coming up, which is that 370 kind of area. And Tesla's kind of stuck between the good area of 320, which is, of course, where we saw that pre-market show. Then we got a little bit of potential news. Turns out that wasn't a done deal. But anyway, pushes it back up. Good narrative, of course, to get us there. And then we've got a lot of options around 360, 375, which could act as kind of call walls. So that is a zone where we might see reselling of Tesla come back in and then hopefully some stabilization of the stock. But now I'm kind of neutral on it to slightly bullish just to these levels and then remain neutral until we see more information. Remember, it's always good to see structure as much as we can. When we go over to NVIDIA, it filled the gap. Congrats to anyone that was gap filling it. Most traded zone was an exceptionally good level to buy. And this is actually a pretty good level to get out before earnings. And then, of course, we see what happens next. But you guys will note that if you look at semiconductors, they've all been improving. And semis are actually behind NVIDIA in terms of gap fills. So some really interesting range. Of course, a very, very key level for us to be looking at. And we will be on top of this one as we go through the earnings. Now, good story has been Intel. We thought this may have bottomed. And the volume keeps coming. Big day, 16%. Congrats to anyone that's been holding this terrible stock for the last couple of years, or even if you've gotten lucky enough to get into it the last couple of months or even weeks, because the structure was improving. We thought this may have bottomed. It does look like it's going to push towards that first $30 target. But if you've missed out, it's going to be very tough to get into it. Risk reward's probably not there. But another day of huge gains here for Intel. And that could also mark that maybe AMD is going to get a little exciting over the next couple of weeks. Something to watch. Some key levels there, of course, will be a 120 plus closure, breaking that downward trend line. For Chinese stocks, all green, all good. Everything seems to be pretty good in terms of sentiment switches here. Obviously, tons of fund managers now saying it's great. Funny how they do that after saying it was terrible for so long. But yeah, big gains, resistance kind of hit here. I'd like to see consolidation, and ultimately, we're looking for a lot higher number. So, of course, I'd like to see a 25,000 on this market at a minimum over the next 3 to 6 months. All right, let's move over to US 2K. No breakout yet. 23.25 could still be a catch-up market. Some risk reward is there for US 2K. Probably going to come down to the yields. 10, 20, 30-year yields breaking below will be the key. And for the NASDAQ, all-time highs. So far, it looks like markets are positive gamma. Markets are pushing higher. Nothing really to be seen there other than to be generally bullish across the board. Now, when we move over to the crypto markets, things look very different. Ethereum, big rally, big dump. I mean, this coin, along with a lot of the coins, all going through the trials and tribulations, still holding small-time positive structure, still holding that 2,600 level and managing to bounce off it. Obviously, we want to see 2950 to really show that the bulls mean control. But anything in here, theoretically, is where I kind of see buyers for now. And Bitcoin did manage to bounce back up after taking those recent lows. Now, of course, this doesn't look like great structure, but if we take now, I'm going to actually bring this down. I feel like if we're taking 99,500 or even 99K, this could be a really great sign for the bulls coming back into Bitcoin. So things are starting to look better from a structure point, even though you may look at this and say, this sucks with boring ass Bitcoin or whatever you're thinking. In general, this is a great structural area. So if we do get the right momentum, the TA will really be in that favor. For now, I guess you could argue the bears are in control, but I would say it's neutral. So neutral with that real case of bullishness because of the backdrop of things like the fear and the greed that's currently in the market, which is, of course, quite fearful. When we take a look at all of the information coming out this week, of course, we did get the RBA statement with the Reserve Bank of Australia. They cut rates for the first time in ages, and that's an interesting thing to see. But generally speaking, it's going to be about the FOMC meeting minutes, which is 2 p.m. on Wednesday, Feb 19th, New York time. And then we scroll down, of course, we start getting some unemployment claims. And then we get a bunch of news from Europe along with PMI. So really this week is probably going to be let the price action play, let the options market play. And in general, I guess as we always like to do at the end of these videos, we like to give a bit of a synopsis. It does seem like positive gamma and the markets are still overall bullish for now. And we haven't got those kind of longer term bad signals. We need to keep an eye on the 200 daily sometime this year, probably is going to get hit. So you can keep that in the back of your mind. And of course, we want to look for rotation. So thanks very much for watching. If you enjoyed today's video, make sure to subscribe. Follow us over on X as well. And if you're interested in checking out our free events, I'm going to close the tickets off there very soon. It's completely free to do so. Perth and Brisbane, get on it right now. Make sure to sign up. Do it now in the comments. And I will see you next week at those live events if you are lucky enough to be in those cities. Thanks so much, everybody. Catch you in the next one.